Let's see. Let me clear that out. Okay, I'm working off of a different company. This is a company that we did. I think it was. I don't know if it was last fall or last spring. I think it was last fall actually. So this is J.M. Smucker, but everything that you see should be essentially the same. You'll go to. Let's see. Let me go here. You'll want to go to Bloomberg and get get the spreadsheet here. I'm assuming you've already done this. I haven't looked at the, I'm going to be looking at the first deliverable assignments this weekend. But you'll want to download that current template in the income statement and then go over here to the balance sheet and do a similar thing, export Excel current template. And so you'll have all of the previous years. So one other thing to note here, it looks as though for some reason I thought Applied had a fiscal year end 12/31, and apparently they don't. This is one other element that we're going to have to deal with. We're right after, well, we're almost all the way through the 2025 fiscal year end, because that is, as you'll notice here, is 6/30/25. So we've got essentially the first quarter, the third quarter of the most recent fiscal year is in. We're just waiting on that fourth quarter. To do this properly, what we should do is to take the 3 quarters and add them up and then project a fourth quarter and make that our 2025. So that would be fiscal year end 2025, year ending on June 30th of 2025. And then all of the subsequent years will be forecast for the full year. So this first year, you'll only want to forecast that very last quarter. We've actually got real data. We may as well use the real data. To forecast that last quarter, I'd recommend going back and looking at the past couple of years of last quarters. So sometimes you get a firm where it is, something like this, where we're really close to being finished up with the fiscal year. And this one is one of those. So, all right. So I'm assuming you've got spreadsheets with your income statement. And then I've also got a balance sheet over here and in this case, I have a full 5 years of historical data. And this balance sheet, although it says standardized, it's not really truly a standardized balance sheet, because typically a standardized balance sheet in general parlance means that you've converted everything as a percent of total assets. What Bloomberg means by standardized is that they've standardized the account at the account level, so that when we look at one company versus another, we're going to see the same series of accounts. So don't make a mistake there. And then, okay, so I'm back over here on the income statement. First thing I want to do is to get some sense of what's going on historically with the accounts relative to revenue, because the majority of our technique here is going to be the percent of sales method. And so we want to really get a sense of, well, what's been happening historically with the costs as a percent of revenue, what's been happening with current assets as a percent of revenue, what about current liabilities as a percent of revenue. And what I've done is I've got 3 different ways I'm going to measure percent of revenue. And I'm going to do one where I just take the most recent full fiscal year. In this particular case, this company's fiscal year end was 4/30. So I'm just going to take this year right here. And so, for instance, if I want cost of revenue, I would take cost of revenue divided by sales, and that would give me the percent that cost of revenue is relative to sales. I'm also going to do a 2-year average. So I'm going to take the most recent year plus the year before that, and I'm going to average those together. And then I'm also, finally, I'm going to do a full 5 years where I'm going all the way back to, in this case, fiscal year 2020. And I'm going to get an average for that. The other thing that I need to do here is that this is pretty much straight out of Bloomberg. And there are a bunch of things that I could fix here. You know, look over here at the list here. I've got revenue up here at the top, and then I've got sales and services and revenue right below that as a sub-account. Well, actually, there are no other sub-accounts, so I may as well clean that up, get rid of one of those. Same thing here with cost of revenue. I've got a sub-account, cost of goods and services, which there's only one sub-account, so I don't really need both of those things, and they just clutter up my spreadsheet. Likewise, when I get down to something like this, operating expenses, I've got actually here, I've got 3 sub-accounts to operating expenses. By the way, can you all see that, or is that, Anthony, you're squinting a bit. I think maybe that's a bit too small, huh? Let me try to get over here.
It was a little blurry.
Sorry. Yeah, just shout out if you can't see something. So here's what I'm talking about is that I'll go back a little bit there. Is that we've got 2 lines that have revenue. We've got 2 lines that have cost of revenue. We've got operating expenses with 3 sub-accounts. Do we need all of that stuff? Well, not really, because, for instance, let's look at, actually, let me just zoom in this way. That'll be a little clearer. There we go. All right. So let's look at the detail. Let's try to figure out what's going on here. Well, SG&A, we know that that's probably an account that we need to keep. And notice that we do have varying amounts. They're not drastically different from one another, but they do vary a little bit. Research and development. For this particular company, R&D is 0 or non-existent. So that account can completely disappear. We don't need that. And then we've got another sub-account here, other operating expenses, which is a really, kind of a 10 to 15% of SG&A. So what I'm going to do eventually is I'm going to collapse all 3 of those accounts into operating expenses and have just one line for all of those accounts, because the big thing here I'm capturing is SG&A. And I can do the same thing down here. We've got non-operating income or loss. Then we've got a couple of sub-accounts that, again, if we look over here to the values, there's really nothing of any consequence in any of those sub-accounts. So I'm going to collapse all of those as well. And then likewise down here, I'm going to collapse all of this and get rid of things like abnormal derivatives, disposal of assets, impairment of goodwill. Most of those things aren't going to affect our company, AIT. And now, if you see some big values in there, like, for instance, right here, under gain or losses on sale, acquisition of businesses, here we see a big value right here. Well, that was an acquisition, right? So not a big surprise that that's there, but we don't want to have that influence anything in the future. So we're going to take account of that. And then we get down basically to right here, income from continued operations. And this is really the number that we're after. But what I'm going to do is I'm going to clean all that up. I'm going to get some percentages as a percent. I'm going to get all of these accounts on a percent of revenue basis, and then we'll go forward from there. So I've already done this. I've got 4 different spreadsheets I'm going to be showing you. Each one is a little more accomplished than the prior one, but I'll show you each step that I took to go from one spreadsheet to the next. So this is the first one. And so let me move over. Unless are there any questions at the moment? I'll jump to the second spreadsheet if there aren't.
Okay, I just want to confirm we're trying to get those numbers as a percentage of revenue basis for the current year, 2-year, and 5-year.
Correct.
Okay,
Absolutely. Yep. Anyone else? All right. Let me go to step 2. Okay, so I've cleaned things up here. You'll notice that what I've chosen to do is I've chosen to take revenue, that the bold one, and I got rid of the sub account there. And then I've also got cost of revenue, and then I've got gross profit is my next account. And the other thing that you should take note of is that gross profit is simply revenue minus cost of goods, right? So while we see that up, when you come out of Bloomberg, you're actually going to have a value there, but in reality, it's a subtotal. When you're doing your pro formas, you want to make all of the things that are simply subtotals of the accounts above it. You want to actually make those subtotals. Now, I've got an example right here. So essentially, right here, I've done this as a subtotal. So I've got C6 minus C7 is what's in this cell. That's gross profit. C is the column right here. And 6 is where revenue is. 7 is where cost of goods sold is. So this subtotal is no longer a value. It's actually a equation right here. And you should do that with all of your subtotals. The reason that I want you to do that is that if we make that a percent of sales instead, suppose we were to decide that cost of goods sold was maybe, I'm just making up an example here, but suppose that management said, we expect to reduce cost of goods sold by 10% over the next 3 years. And they've got some sort of plan as to how they're actually going to do that. And you believe that they're actually going to be successful at that. So you want that to be reflected in your pro forma. Well, if I just change cost of goods sold here to reflect that, and I don't do anything, and I have this actually as a percent of sales as well, the next line down isn't going to capture that unless it's a subtotal. So, if I change this value here, obviously that updates, right? But if this line right here, if gross profit is as a percent of sales, and I change this cell up here, the gross profit isn't going to change. So it won't reflect what I really want it to do. So I'm trying to build as robust a spreadsheet here that's as widely useful and something that I can work from. So be careful of those. So all of these subtotals, the gross profit, operating income is another subtotal, and you'll notice that I've also done that as a formula right up here, right? Then we go down non-operating income, and then we've got pre-tax income adjusted, abnormal losses or gains, pre-tax income gap, and then we've got income tax expense, and then finally we come down here to net income gap, and then net income available to common adjusted. So I'm going to go with this net income gap as my measure of net income. Now, you'll also see over here, and let me slide over so you can see things. Here are my various averages so I can look at what's been going on historically with the firm and the various expenses relative to revenues. Obviously, this first row is revenue, so revenue as a percent of revenue is 100%. But then the second row is cost of goods sold. So what I've done here is I've averaged the amount of cost of goods sold as a percent of revenue for both 2020, 21, 22, 23, and 24. So on average across those 5 years, cost of goods has been about 63%. And actually, if I add a decimal place, we can see that it's really actually been 63.4%. Right? And then that formula, by the way, an easy way to do that, I'm just taking the average of the cost of goods that's in row 7, columns C through G, And then I'm dividing that by the average of revenues in row 6, C through G as well. And I've locked the row reference here for revenues. So once I've written that formula, and then all I have to do is drag it down, and I've got all the others, right? So all I have to do is write this one formula, and then literally I'll drag it down like this, and everything updates, and you're done. Now, the other two columns, this is just 2 years. So again, notice my formula here. It's the average of row 6. Wait a minute. Oh yeah, because I'm on revenue here. I was going to say, what the heck? Yeah, so this is column F through G, row 6 divided by column F through G, row 6, and that gives me my revenue. And again, I've locked the latter ones because I want those to be the same, and then I can just drag this down, and I've got all of my expenses on the income statement as a percent of revenue. And likewise, this one is just simply the last year. So this one is 2024. You could do other variations on this. I just chose to do these 3 to get a look at it. And what you'll notice is that here, cost of goods looks to be fairly consistent across these. It looks like it popped up a little bit in 2 years ago, but then dropped back down in the most recent year. So 63 is probably a good estimate. Down here, it looks like our other expenses, I believe that's what we have here. Yeah, operating expenses, sorry, are pretty consistent across years. As our non-operating income or losses, those are pretty consistent. Now here, we've got a big jump between the 2 year and the 5 year, and then back down to the 1 year. And that's driven entirely by this acquisition right here. Now, you'll have to look at AITs as you build it and see if there are any oddities like that. And if it's something that is a one-time, one-shot deal, then you don't want it to be spread across your projected 5 years. If you think it's something that might be repeated, you do want to somehow capture that. So keep that in mind as you're looking at the company. There may be activities that they do regularly. Some companies will grow by acquisition. So every couple of years, they're actually out in the marketplace buying up other smaller companies and adding it to the company. So if that's what the company you're studying does, you want to reflect that in your pro forma. In our case, with this example, I don't, because I know this is a one-off acquisition, and it's not going to be repeated in the near future. And then I look down here at my income taxes, and they all look kind of reasonably the same, regardless of which I use. And then here's my net income. Net income varies a little bit, but that's largely, again, driven by this acquisition in fiscal year 2023. All right, so those are my historical relations in the income statement. I have a similar thing, and when I go over here to the balance sheet, I've also cleaned up the balance sheet and made it a little bit easier to read. So I've consolidated some accounts. I did leave my inventories with sub-accounts. So raw materials and finished goods, I've got those as sub-accounts, and I'm going to try to use that out into my pro forma, into my projections. And then just other short-term assets. Under under fixed assets, all I have is PPE as well as other long-term assets. And I'm also leaving my PPE sub-accounts in. So this sub-account here in row 15 is gross property, plant, and equipment. and then subtract from that all of the accumulated depreciation over time. And you add, you take row 15 minus row 16, and you end up with the value in row 14. You'll notice, for example, 3886.7 minus 1768.9 should give us approximately 2117.8. And when I'm doing that, I'm actually, again, I'm doing it as an actual subtotal. So this row 14 is a subtotal of 15 and 16, the two sub-accounts. So be very, very, very careful, especially as you go through this the first time, so that you're not adding the wrong things together, or that you're subtracting where you should, or you're adding where you should, that sort of thing. Be super careful on that. Also notice that, for instance, the inventories account up here, it has these two sub-accounts, raw materials and finished goods, and you'll notice that that too is a subtotal. Now in this case, it's the two added together. In the case of PPE, it's the gross PPE minus accumulated depreciation. So, make sure that that's all working out. Again, total current assets is a subtotal, and I'm just adding my my net PPE with my other long-term assets, and I get total non-current assets. My total current assets is also a subtotal, and it's other short-term assets, inventories, AR, and cash. And then finally, to get my total assets, again, I'm adding together the total current assets along with the total non-current assets, and I get total assets. All right. Do a similar thing down here on the liabilities and equity side, and you'll notice that I've cleaned it up considerably from the output that Bloomberg gives you. I'm just doing it to kind of keep things neat. The other thing you want to recognize is that we don't know AIT as well as we'd probably like to know it. So many of these sub-accounts have a level of detail that is not observable to the casual observer, and not easily learned unless you already know the company and you've followed it, or you've talked to management and you've said, hey, what about this account? What are you doing with this account? In our case, we don't have that option. You'll notice in the liabilities, we've got payables, we've got short-term debt, and we've got other short-term liabilities. It looks like short-term debt has varied quite a bit over time for this particular company, whereas other short-term liabilities have been relatively modest and at quite low levels. And then under long-term debt, I've got the regular bonds, LT debt, and then I've got other long-term liabilities, mainly taxes in this case. And then total non-current liabilities. And let's see. So again, that's also a subtotal. And then I've got total liabilities. Under equities, I have share capital and additional paid-in capital, which is actually a net of these two sub-accounts. So common stock and then APIC, or additional paid-in capital. The way that works is that every balance sheet that you see is going to have those two accounts, and they're going to be netted out into this to this net account. The common stock account is simply the par value per share times the total number of shares that are currently outstanding. All right, so par value might be on the order of, it could be a penny, it could be 10 cents, it could be $1. Some par values are even smaller than a penny. They might be a hundredth of a penny. But that's what that amount is. And then the APIC is whatever the stock was actually sold for, minus the common stock value, minus this value up here. And then the two together are the total value of the equity. Then retained earnings is the accumulated retained earnings from all prior years. And so that's going to be something we'll have to deal with in our pro formas, because each year we close out the books, we need to transfer whatever is left over, what doesn't get paid out as net or as dividends. We need to transfer that over here from the income statement over to the balance sheet. And that adds to the retained earnings account. And then apparently this company had some small amounts in this other equity. I'm not sure what that was. And then finally we have the total equity, which again is a sum of these three accounts: the share capital plus APIC, retained earnings, and then other equity. And then finally we add together equity and liabilities. And obviously we hope that those balance out 16,970.4, 16,970.4. Everything is good. And we've got that for all the 4 years. The other thing I've done here is, well, let me stop here and see if there are any questions.
I do have one.
Okay, go ahead, Abby.
With this consolidating process, I understand that a big part of it is creating the subtotals for like the
Yep.
broader categories.
Yep.
Would you say like the rest of the process for consolidating is just deleting rows of things that are zero and then manually going in to enter rows that like can fit under a broader category, like we saw with APIC? Like, is that just something you can do manually without
Yep.
a subtotal and then just delete the row?
Yep, absolutely. Yeah. I mean, if we go back to the other spreadsheet, that first one I had, and we look at the balance sheet, and well, look at all these accounts down here. I've cleaned up a lot of this and just thrown it in as other long-term debt. We've got accrued liabilities, pensions, other post-retirement benefits, deferred revenue, a lot of things that are probably not going to matter to us and probably have modest amounts in them or are very stable over time. Either of those two things apply, and I'm going to kind of consolidate everything and clean it up. Even here, I've got, here I had, they had a preferred equity and hybrid capital. Well, there are no values in that, so I just got rid of the account. The way these are done by Bloomberg, they try to make everything the same set of accounts for every firm, and it does. Some of these accounts just don't apply to every firm. So the way to not have to deal with all of these things is just clean it up and delete them. Also, notice here minority and non-controlling interests. It was all zeros, so I just deleted that account.
Thank you.
Sure.
Excuse me, sir.
Yeah, go ahead, Leo.
The first question, can you explain again what you said on the common stock line? I didn't get it.
On the how I aggregated it, is that
Yes.
so? Right here, right?
Yes.
So this common stock value is there's always Gesundheit, Anthony. There's always a some sort of par value that is attributed to the stock. This dates way back to when stock corporations were first invented several hundred years ago, and they had this idea that they needed to have some sort of par value, some sort of value that you could almost think of it as a redemption value, right? And it was typically $1 back then, and the stock might be selling for $10. So it was a pretty significant chunk of the value of the stock, but that was viewed as a way of giving people who didn't understand corporations yet at that time some sort of comfort that, yeah, it's not just a piece of paper. It actually has, we'll give you $1 for the piece of paper at worst, right? So this concept has existed from then till now. We still have the concept. So these two accounts are what you'll typically see. And so this is just that par value times the total shares out. this is the total amount generated from all stock sales that are still outstanding, have shares outstanding, minus this amount. And so the sum of those two together is the share capital in APIC. Does that help, Leo?
Like it's more obscure than before, but I would just have a look. Like don't spend 10 minutes on this thing. I would just have a look at it.
Okay. Yeah. So this value, this 5823.1, is the sum of 5794.1 plus 29.
Okay.
Yeah. So it's just a subtotal of those two.
Okay.
Sure. Other questions or comments? All right. Now, some other things I've done here is I've also done these multiple number of years. I've done a 1, 2, and a 5-year percent of revenue for my current account. And so now, another thing that I want you to be super careful with is that when you get a standardized balance sheet is each of the balance sheet accounts as a percent of total assets. And remember, that's not what we're doing here. We're doing a percent of sales pro forma financial statements. So we need the balance sheet accounts as a percent of revenue, not of assets. So to do that, I'm actually going between the two sheets, both the balance sheet and the income statement. And you'll notice up here, let me just show you the most recent fiscal year. I mislabeled this. This should be 2024, not 2020. Wait a minute. What's going on here? Yeah, that should be 2020. I've got these mislabeled too. I'm not sure why this spreadsheet is kind of messed up. This should be 2025 and 6 and 7. Oops. Sorry about that. All right. So as a percent of sales, this would be cash, right? In row 7 is cash. And so what I'm doing to get the most recent year, I'm taking that value, that G7, which is $62 in this case. It's right here. I'm taking that and dividing it by the income statement cell G6. So let's go over and take a look at the income statement. And when I go to G6, that's where I have my revenue. So I'm taking cash divided by revenue. And I'm doing a similar thing for the accounts receivable here. I've got in row 8, I've got accounts receivable, and it's 736.5. And I'm dividing that 736.5 by the revenue on the income statement. So again, there's that income and exclamation point, and then G6. I've locked the row so that I can easily drag and copy things without having to change too much. Similarly here, I've done an average for 2 years. So I've done 2024 and 2023, and then I've done the 5-year averages here. And you can either do the ratios for each year and do an average of those, or you can do the average of whatever the numerator is divided by the average of the denominator. You'll get the same value. I just chose to do it this way. It seemed like a little easier means of doing it. So now I have that. I actually should, although I don't have it on this particular step, you'll see it in the next one. I should have done something similar for the current liabilities. So the accounts payable, the short-term debt, and other short-term liabilities. I didn't have it on this sheet, but in fact, I could actually just, let's see, I should be able to just copy this and go down here. And I think, no, I need to drag this down like that. And then I can do a similar thing over here. Oops. Come here. And I'll just drag this down. All right. So now I have all of my percent of sales on my balance sheet, and I've got all of my percent of sales accounts here on my income statement. And then I've added 5 columns out here to the right. Those are the years that I'm going to be projecting out to. So in this case, we're projecting 2025, 6, 7, 8, and 9. And likewise on my balance sheet, 25, 6, 7, 8, and 9. All right. And that's it for this particular spreadsheet. So let me move on to my third spreadsheet, which takes this and adds to it. So you'll see, let me go back to the income statement. Let's zoom out a little bit so you can see everything. So here are my percent of sales for my 5, 2, and 1 year. And then I have my projected values for my 5 projected income statements. And I'm going to zoom back in on this. And you'll see that, okay, so in 2024, our revenue was 8178.7. In fiscal year 2025, I'm projecting that revenue will grow at 4%, and it will then be 8506. And notice again that this is a formula. So what I've done is I've taken the prior year's revenue, this one right here, fiscal year 2024. I have multiplied that by 1 plus the growth rate for that year up here. Now, you don't have to do this, but what I've done is I've chosen to have my revenue growth be independent for each year. I could make them all 4% like I have right here, or I can change 1 year, or I can change 2 years, whatever I want to do. So that just builds in a little bit more flexibility for me. But that would be my revenue for 2025. And then I go down to my cost of goods, or cost of revenue is what the account is called here. I go down to that, and now I have to pick what percentage I'm going to use. And after looking at this, I have chosen to go with the 5-year average. And I don't know if you've used this choose function, but it's kind of a cool little add-on to this deal. You don't absolutely have to do this, but this allows me to actually change the average that I'm using. I could use the 1 year. I could use the 1 year percent of sales. I could use the 2-year average. Or I could use the 5-year average. The way this works is that I write choose, which is the function, and then I identify this I2, and you'll notice that I2 is right up here. It's this number in the red. Oopsie daisy. There, right there. Oh, went a little too far out. Sorry about that. Hope nobody's seasick. So what I've done is I'm saying use the column that is identified by 1, and you'll notice that this column right here is identified as column 1. If I were to change it to 2, it would use the 2-year average. If I were to change it to the 3, it would use the 1 year, the most current year. So if I change this to 2, watch what happens to, for instance, the cost of revenue here was $53.97. If I change this to 2, it should go up a little bit. And sure enough, it does. It goes up to 54.81 because we're using this 64% of revenue as opposed to this, which is 63%. So it's kind of a handy dandy little thing. I can play around a little bit with it just at the click of one key, change one cell, and it updates all of the references to that to this other average, either the 1, the 2, or the 5-year averages. Let's see. So also notice that I've done the subtotals. So gross profit is simply revenue minus cost of revenue or cost of goods sold. And then I go on down to operating expenses. And operating expenses, again, I've got that choose function in there. And it says choose based upon cell I2, choose one of these three, either H9, I9, or J9. And since I've got a 1 in here, in I2, it's going to choose H9. It's going to choose the 5-year average. And then again, I've got a subtotal, which is the gross profit minus the operating expenses, and then keep working your way down. It all works out. Now, just in terms of convenience and how to go about this the quickest way, what I'd suggest you do is to create this formula right here for your cost of goods sold, right? Lock in all of the references. So I want I2 to be locked in. Do I want it locked in completely? Yeah, I want that totally locked in, because no matter whether I go to the right or down, I still want to reference this cell right up here, this I2. Then I've also locked the column on H, I, and J, and I've locked the row that I'm going to go back and multiply by that percentage. So that's back here, right here. Should be this. Sorry. It's K. Sorry, it's revenue. I'm doing everything off of this revenue. And then what you can do is you could just copy down all the way to the bottom. I'm not going to do that because I don't want to change all of my other subtotals, but copy down, and then I would change this back to a subtotal. So I just have this is revenue minus cost of goods sold, and I'm going to bold that. So, I mean, it just saves you a little bit of time, and you can go back in and change the subtotals. Those are easier to write than those choose formulas. Similarly, you can take this across and update it this way. And so, like I say, once you've done one formula, copy down, copy right, change the subtotals to actual subtotals, put the bolding in, whatever you want to do, and you're done. Literally a couple of minutes at most. And I've done this all the way down to net income here. And again, net income is simply a subtotal. It's the pre-tax income minus taxes. And so the other thing you always want to do is to kind of do a sort of a gut check, you know, does this net income make sense? Well, yeah, sort of. We've got 780, 876, 630, negative 91. Well, that was the acquisition, right? 744. And then so if I've grown a little bit, okay, 833 makes sense. 870, I'm growing at 4% regularly. 909, 949, 991. So all of that sort of, oops, I'm in the way. All of that sort of makes sense, right? So always check your work and make sure that the numbers are looking like they should, like you think they should. The other thing I've done here is I have also calculated how much of the net income is going to be paid out in the form of dividends and how much we are going to retain for reinvestment inside the firm. And I've done that by calculating I need to calculate my dividend. I've got that down here though. And if you look, when you download the income statement off of Bloomberg, you'll have a bunch of data underneath these reference items here. and they can be very handy. Under the reference items, we not only do we have that, but right up here we have diluted weighted average number of shares, and that's a number that you're going to need too. These are denoted in millions. So, for instance, in fiscal year 2024, the diluted weighted average shares was 104.4 million shares outstanding. And that includes all of the, say, if they've issued stock options to executives, that's factored into there, that those stock options will at some point be exercised. So we've got the shares outstanding. We also know, let's see, we know total cash dividends. We know dividends per share. And so what we can do is we can say, well, what is our next dividend going to be? If the current one was $4.24 and the prior one was $4.08 and the one prior to that was $3.96 per share, remember what we said about dividends when we talked about that. Companies want those to be very, very stable and just grow a little bit each year, or maybe even every 2 years, but nothing crazy. EPS may go up and down, but we want dividends to be a very stable, predictable process. So I've got a, let's see, we've got what, 12-cent change here. We've got a 16-cent change here. And so I chose to do a 12-cent increase. Oops, sorry, let me get out of the way here. I'm just, oops, wrong keyboard. There, now you can see this. So I chose, since this is the most recent announced dividend, $4.24, I chose to increase at 12 cents. So I went to $4.36. And then this next one, I increased by 14 cents to $4.50, and then 15 cents, and then another 15 cents. And then here I went 20 cents, and then another 15. I'm trying to project basically what I think management would do over those years. Then I've also taken that dividend per share and I've multiplied it by the shares outstanding. And so that gives me, I actually have shares outstanding down here as well, that 104.1 million. And so what I've got here is I've changed it back into millions. Pardon me. And so it's J41 times G47 divided by a million, and that gives me 453.9 million aggregate dividend expense. I come back up here to my net income, 833. Subtract from that. Oh. Sorry, I was in the wrong column here. I don't, 24. Not sure why, I haven't looked at this spreadsheet recently. I apologize. I'm not sure why these are here. I don't think these need to be here. So let me come back up to here. What I've done is I've taken net income, 833, minus the aggregate dividend expense of 468.5, and that leaves me with 364. That's the amount that is going to go back to the balance sheet and get added into that retained earnings account on the equity side of the balance sheet. Same thing here. Again, I've taken the net income of 870, subtracted from that the aggregate dividend of 484.1, and I've ended up with a new addition to retained earnings of 386. I've got 409 here, 429 here, and 455 here. And I've done that because I know that I'm going to need it on the balance sheet. So I've just done the computation right here. So I've already got it ready to go when I get to the balance sheet. So I've jumped through a lot here. It's probably a good spot to say other questions that you might have. None? All right, let's keep going. Onto the balance sheet. We're doing similar things there. Here's all of our current accounts that we assume are going to vary directly with revenue. Now, you'll notice that I haven't done that. I haven't done anything for the fixed assets. And the reason is that if you'll remember chapter 19, how we talked about, well, fixed assets don't necessarily change spontaneously with revenue. You know, if we have a plant where capacity is, we've got some excess capacity, you know, we don't need to increase fixed assets necessarily to support a higher level of sales. So we're going to leave that for the moment. We'll come back to it in a bit. Here's my current liabilities as a percent of sales. And then you'll also notice that I haven't done anything with the long-term debt or the equity yet. And again, that's because those two things don't necessarily change spontaneously with sales. They're going to be driven by what we do with the fixed assets and what sort of retained earnings we get from the prior year on our balance sheet. All right, so let's go through the balance sheet here. Let's start up in the asset side. And we've got cash and cash equivalents. And again, that I'm using this choose function. And again, it's the same sort of thing. I'm referencing these cells, and I actually have allowed myself to change the percent of revenue on the balance sheet separately from the income statement. So I could actually, on this one, I could pick the 2-year or the most recent year. And on the income statement, I could still have the 5-year. Just a little more flexibility, but not a requirement. So here I use that choose function. That first reference is the cell that is going to identify which column we're going to be using. And then here are the 3 columns, H8, or 3 cells, H8, I8, and J8. And then I'm going to multiply that by my income, by my revenue on the income statement. That's cell K6. So that's my new cash balance. And notice that that reference is in cell K6. Let's just go back and double check here. K6, there it is. So that's actually my 2025 revenue, which is driving my 2025 cash on the balance sheet. All right. And then I do a similar thing for accounts receivable. Inventory, I've actually done the same thing. And I've chosen, I should have changed these two subtotals. And let's see, let me go ahead and do that right now because this is wrong. I want this to be the sum of these 3 guys. And I'm going to do that all the way across. Interesting. That came out slightly differently, but that's what I want to do. So here I've got, sorry. I goofed. Nobody called me on that one. Come on. I went down 3 rows and I should have only gone down 2. That's why I got a change in those. All right, so let me fix that. There we go. Now we're back where we should be. So this is actually a subtotal of the 2 sub-accounts below it. And then I've got other short-term assets. And again, I've done this as a percent of sales using the 5-year average. And then this one, again, is a subtotal. Notice it's the cash, the accounts receivable, the net inventories and the other short-term assets. There's the well, here's the formula for that. All right. And again, I've done this such that I can just do a drag right, drag down. I've done all 5 years, and I've done all accounts this way. And I'd go back in and adjust my subtotals individually. So this subtotal is all the current accounts. Wait a minute. Come on down here. There we go. And then I've got my plant, property, and equipment net. Again, that is also that subtotal of gross property, plant, property, and equipment, and then minus the accumulated depreciation. And then other long-term assets. This particular one, I've decided to leave that constant. And, I based that decision by looking at what I had historically, and I don't know what those other long-term assets are. Now, again, if I was doing this for money, if I knew this company well, if it was a company that I followed regularly, I would probably know exactly what's in those those other long-term assets. For you all, we're not going to worry about that. I don't think I've used this analogy in this semester yet, but I'm equating what we're doing as the 100-piece puzzle as opposed to the 1,000-piece puzzle. So we're not going to have as much detail. We're not going to have all the bells and whistles. We're going to have the essential stuff. And that's it. Total non-current assets, again, just a sum of the net PPE and other long-term assets. And then total assets is the total current plus total non-current. And, oops, I'm in the way. Let me just slide this over for you so you can see a little better. Oh, my camera decided to not focus. Come on. Oh, well. Huh, strange. There it goes. All right. Down here to payables. Payables, we are going to assume change spontaneously with revenues. So again, I'm using our choose function there, and I'm going to take 19% of 2025 revenues to tell me what my payables are going to be. Similarly, with short-term debt as well as other short-term debt, I'm going to do that as 9% and 2% of total revenues, respectively. And then again, I've got another subtotal here, which is just all three of those accounts added up. Long-term debt, we're going to come back to. And that long-term debt and the additional paid-in capital and common stock, those are accounts that we are going to use as what we call the plug accounts. We're going to plug in numbers that force the balance sheet to balance. All right. And you can think of that as, if you remember, we talked about external financing needs. This is when we'll find out what those are going to be. Okay, so before we get there, we've got to do something with our retained earnings. Because remember, we've got the net income that didn't get paid out as a dividend over on the income statement. And we have to bring it over here to the balance sheet and add it to the accumulated value at in the prior year. So retained earnings back in 2024 were $2.188 billion. Okay, so it'll be at least that, as long as we made money and we didn't pay everything out in a dividend. It'll be 2188.1 plus what we earned this year that didn't get paid out. And you'll notice up here, again with this formula, I referenced that fiscal year 2024. That's the G34. Right down here, that's G34. And then I add to that the cell reference on the income statement sheet, which is K17. So let's go take a look at K17. And yep, lo and behold, there's K17. That's my retained earnings. I took my net income, subtracted off the dividends that we paid, and there's our dividend, our aggregate dividend, and the amount is 364. So our new retained earnings account is 2188.1 plus 364 equals 2553. And again, I'm going to do the same thing for the next year and the year after that and the year after that and so forth. Now, one thing you'll notice, the way I built my spreadsheet, since I stuck these 3 columns in here, I have to write this formula, and then here I'm looking back, to the 4 columns back, 1, 2, 3, 4 columns. But over here, this next one, I'm only looking back to the prior column. So I have to write these 2 columns separately. And then once I've written that, then I can drag and drop this over and it'll do it all properly. Now, if you built your spreadsheet a little bit smarter and didn't put this in the middle of it, you could start from that first projected column and just drag everything over to the right. But you get the idea. Okay. What else here? Oh, I also chose to just leave this other equity as a negative value, and I left it constant at 235 for each of the years. I don't know what it is. Again, if we were doing the 1,000-piece puzzle, I would need to know what that is. But given that we're doing the 100-piece puzzle, I'm not too worried about it. It's a small number, And then I've got my subtotal here, and then I have my liabilities and equity, which should equal my assets. Now, it does, but it only does that because I've already made that I've already forced that balance. The way we're going to force that balance is using these 2 accounts, the ones in light blue. So this one is long-term debt, and the other one is the share capital plus APIC. Those are the accounts that are going to force the liabilities plus equity to equal the assets. Before we get to that, let's talk about assets. Let's talk about non-current assets, in fact, fixed assets. Here, what I've done is, again, I've built in some flexibility for myself. You'll notice up here at the top, I have assumed increase in PPE. And I've got that written in as 400, and I've got accumulated depreciation, or additions to accumulated depreciation, I should say, at 130 per year. Now, that might not be flexible enough. I might really want to make it for each year to make it different. Depending upon what the firm is doing. Let's say that the firm says, hey, we're going to acquire a new company next year. Well, I'd want to build that into that. So I'd want to be able to do that for each year. So what you could do to be even more flexible is, say, put your assumed increase in PPE here, and then the additions to accumulated depreciation here, and do the same thing for the next year in these 2 cells, same thing for the next year in these 2 cells, and so on, all the way out to here. I've just done it one size fits all, but you may want to make it a little more flexible than that. You'll notice here that I reference, hang on a second. Actually, let me go down to gross. You'll notice that I take the last year's gross PPE and I add the 400 to it, and I come up with 5747. Same thing happens here with my accumulated depreciation. I take last year's, the 2100, and again, I hope that's more or less visible to y'all. Let me get back to that. Here we go. I take that 2100 and I add to it the 130, and I end up with 2230. And I do a similar thing here. and likewise with the gross assets there. And then, of course, the net PPE is simply gross assets minus accumulated depreciation. And like I said before, the other long-term assets I left as constant. So those are going to be the same. Questions about that? Okay, good. That part of it, it depends on the company as to how quickly your assets are going to grow. Do your best as you're reading the annual reports, as you're listening to the earnings calls for AIT, do your best to try to figure out where they're at capacity-wise. They may actually, one of the analysts may have come out and out with the question, but, or maybe they don't even mention it. Maybe they assume everybody already knows that. But, as you're reading, that's one thing that I would recommend that you look for, is to see if you can get some sense of, are they at capacity? Do they have some excess capacity? Are there plans for an expansion? You'll want to build all of that into your pro forma as you build this. Remember, the idea is for this 5 years that we're projecting to be as close to the actual 5 years as humanly possible. All right, so now we have total assets here. Now, the problem is that some of the assets change spontaneously with sales, but some of the assets changed at a different rate. And so when we match that up against liabilities and equity, we've got some of the liabilities that change spontaneously with revenue, but then we've got, one account down here that is different. And then these other accounts we handle differently. This one, the other long-term debt, again, I just assumed was constant. I'm not worried about small values. Now, if you know that there's something in the other long-term debt that's going to change, you want it to be reflected. But in this case, I felt like it was okay to just leave it constant. Now, if we were to not have these formulas in here in cell K27 and cell K31, the liabilities and equities would not add up to equal total assets. But we have to have it equal total assets because it's a balance sheet, and balance sheets have to balance. All right? So what I've done, so the next thing you need to determine is, what kind of leverage do we foresee the company having over the course of the next 5 years? And again, this is something that you'll want to look for as you read the 10K, the 10Q, listen to the earnings calls, anything else you can figure out, or looking historically at the company, anything else you can do to figure out what they're doing capital structure-wise. Some firms don't manage it too closely. Other firms are very detailed. They might have a target capital structure that they're shooting for, and as it deviates from that, they'll try to drive it back down or up to the average. It's up to you all to figure out what AIT is doing. And again, remember, we're not there as consultants. We're not there to say, oh, you should have more leverage, or oh, you should have less leverage because your Altman Z-score is low, or is high, rather. High Altman Z-scores mean you're close to bankruptcy. But it's up to us to just observe and report what we see. And if we can tell what management is going to do, then we'll be able to build a spreadsheet that better reflects that. What I have done in this particular case up here in this cell, where I call it debt to assets, what I've done is I've actually calculated I believe it's the current debt to assets, G30 over G20. And let me go over here and find G. Yeah, this is fiscal year 2024. So G30 is my total liabilities. divided by G20, which is my total assets. So that's total debt or total liabilities over total assets. And in the last reported year, that turned out to be 62.05%. All right. And I made the assumption that they're at an optimal leverage level and they're going to keep that constant. Again, it may not be the case for AIT. You've got to do your research and see whether that is true. In this particular company's case, we're assuming that they're going to leave their leverage around 62%. Now, with that in mind, what I can do is I already have, I'm going to zoom back out a little bit. I already have accounts payable. I already have short-term debt. I already have short-term liabilities, other short-term liabilities. I also already have other long-term liabilities. Those are the only accounts in the liability side of the balance sheet. So what I'm going to do is I'm going to force this amount of total debt to be exactly enough to make the total liabilities 62.05% of total assets. Here's the formula. So I'm taking the Q1, which is my 2024 debt to assets ratio, 62.05. I'm multiplying that by total assets for fiscal year 2025, my projected year. So 62.05% of $20.827 billion. Then I'm going to subtract from that my current liabilities, which I've already determined, as well as my other long-term liabilities down here, 1893. And that amount of long-term debt will be exactly the amount that I need for total liabilities to be exactly 62.05% of total assets. No matter what I can change my growth rate on my income statement. I can change the relation between cost of goods sold and revenue. I can change the relation between cash and revenue. I can change anything on this spreadsheet, but my balance sheet will still balance, no matter what. I'll prove it to you. So let's change the amount of plant, property, and equipment. I'll change it to 600. And we should see the total assets go up, and we'll also see total liabilities go up, but we'll see that liabilities plus equity still equals total assets. So I've changed it to 600. I've hit the enter key. Now total assets go up to 21.027. Liabilities go up to 13.047. And total liabilities plus equities is 21.027, exactly what we had up here for total liabilities, or total assets, pardon me. If I change it back to 400, it goes back, and all is good in the world. That took a little moment to update, but it finally did. All right, so that's the plug figure for liabilities. I still have to have a plug figure, though, for equities. And that comes in right down here. What I chose to do here, actually, I misled you on the prior spreadsheet. I actually collapsed common stock and APIC into a single account. So theoretically, I could get rid of both of these lines and clean up my balance sheet a little bit. But what you'll see is that what I've done for share capital and APIC is I've said, I'm going to take 1 minus Q1, so 1 minus 62.05, which is what, 37.95, times K20. Again, that K20 is my total assets for the year. And then I'm going to subtract from that any of the other equity accounts. That would be, in this case, retained earnings down here at K34, and other equity at K35. So that's what I'm subtracting off of that amount. So that amount of equity will exactly cause my total equity to be 37.95% of my assets. And then when I add total equity with total liabilities, I come up with exactly the same amount as my total assets are. So these two blue lines are really important. They're the plug figures. They're what makes this spreadsheet, or what makes this balance sheet balance. So let me stop there. I've gone over a couple of steps here. The next thing we're going to do is we're at a point where we can project our free cash flow to equity. But I want to make sure everybody is still on board or doesn't have any other questions about what I've just covered.
I don't have any other questions, but I do think I'm going to have to head out.
Okay. I'll put this recording up so you can catch the rest of it afterwards.
That would be great. Thank you so much.
You're welcome, Abby. Yep. See you, Leo. See you all in class next week. Anything else? All right. We're almost there. We should be able to wrap it up in about 15 minutes, so I apologize for it running long, but I want to try to cover everything here. All right, so let me go to my fourth and final spreadsheet here, which has all of my free cash flow to equity computations. So here we are back on the balance sheet, here we are in the income statement, and now I've added some elements just under my income statement. Now, where you put this is up to you. You know, you could arrange things quite a bit differently. Maybe you have a one page that has all the variables that you can change with all of your free cash flows and your final values, and you reference the income in the balance sheet on a different tab. That might even be a cleaner way than what I've done here. But what I have here is, this is my free cash flow to equity computation. I need I need three things, or I can't speak. I need five elements here to get to free cash flow for equity. I need net income, I need depreciation, I need changes in net working capital, changes in CapEx, and then I need net borrowings. And that net borrowings is the important one, because that's what differs from the textbook free cash flow to the firm and what we're doing here, which is free cash flow to equity. The difference between the book and what we're doing here is the book is valuing the entire firm. We're just valuing the equity piece of it directly. In the book, they valued the whole firm and then they subtracted off the debt piece, and we were left with equity. Here, we're going straight to equity. We don't have to subtract off debt at the end. All right. So one other reference here that you might find handy is if you go to the modules and open up the assignment, under the FAQs, you will find a link right here to this wallstreetmojo.com website. And that website is got a bunch of great information about corporate finance and investments in general. It's done by CFAs type folks, and it's really good material. A lot of it is free, and this particular page I'm showing you right here is free. A lot of ads and pop-ups, but it's otherwise good. So what is free cash flow to equity? And then they talk a little bit about the overview of what free cash flow to equity is. The really nice stuff, though, let me try to get rid of this pop-up, is that they'll come down here and they'll start to show you the actual formula that you're going to use for that. So you'll notice that the formula is net income plus non-cash charges, that would be our depreciation, plus changes in working capital. Now, it depends. Usually working capital goes up, so that means that this is actually a negative. it's an expense you are adding to working capital. As we increase revenues, it's not unusual for net working capital to increase as well. CapEx is also a negative, typically. That's because we're usually expanding. We're adding to the plant, property, and equipment. Net borrowings, that could be positive or negative. And what that is it's actually the debt issued minus debt repaid. So if we repay more of the debt than we issue during any given year, we're actually reducing our net borrowings. And that would make it a subtraction. If we issue more debt than we repay, then we're increasing our borrowings, and that's cash inflow. Always think about this in terms of cash flow. If it causes cash inflow, then it's a positive. If it causes cash outflow, it's a negative. So it goes through that. It also shows you that you don't have to start at net income. You can start at EBIT and get to the same spot. It's just a slightly different variation on that formula. And then they actually go through and they talk to you about, more specifics about each of the elements of that formula. So they talk about depreciation, changes in net working capital, CapEx, net borrowings, and so forth. Boy, the pop-ups are a little annoying, I have to say. And then we get down here to an example. Doggone it, go away. Yeah, please. This example is actually a spreadsheet. And they will show you precisely how to write the formulas even for the spreadsheet, like right here. Changes in net working capital. Well, how do we get that? It's current. What's working capital? Well, or net working capital. It's current assets minus current liabilities. They usually leave out cash. So here we could say accounts receivable plus inventory minus accounts payable. That would be my working capital. Now, the change in working capital, though, is what we have this year minus what we had last year in net working capital. So you'll notice that last year, by the way, they've got their years are actually decreasing as you go to the right. So this last column is 2015. The first column is 2016. Last year, they had $45 in accounts receivable and $90 in inventory, $60 in accounts payable. So that'd be what, $135 minus $60. So they had a net working capital of $75, right? Here it went up to, let's see, $210 minus $60. So that would be $150. So net working capital went up. But you'll notice that here's the formula that you can write to get that net working capital. It's got to be the current year minus the prior year. And it goes through all of that. It also does that, shows you how to do the net borrowings, CapEx, etc. So it's read through this before you try to do the free cash flow calculations. All right, back to the spreadsheet. So I've chosen to use that first formula, net income, add back depreciation, subtract off net working capital, subtract off CapEx, and add or subtract net borrowings. So here, again, these all should be formulas. We've got K16, which is our net income from just above here, 842. We're going to add to that the depreciation, which that comes off the balance sheet. And remember, that's a change in depreciation. So you'll notice that I actually have that as K17 minus G17. So let's go to the balance sheet and look at K17 minus G17. I've got K17 is right there. And G17 is right here. So that amounts to $130, which corresponds, of course, because that's what I set up as my accumulated depreciation increase each year. So that's what that number is. Let me go back to the income statement. And then change in net working capital. Here's where I've taken the current assets, that's K9 plus K10, minus current liabilities, payables, accounts payable, that's K23. And that is for the current year. And I've subtracted from that the prior year working capital, which is, again, it's G9. That would be the accounts receivable plus the inventory minus the accounts payable. And that figure turns out to be $69. CapEx, similarly, I'm taking the current year's net plant, property, and equipment, and I'm subtracting from it the prior year. So G16 is, gross. It's gross, not net. My apologies. Gross plant, property, and equipment. So there's my K16. Here's my G16 right here. And then finally, my net borrowings is the long-term liabilities or long-term debt plus short-term debt minus the prior year's long-term liabilities plus short-term debt. That's G24, G27. Let's go over here. G24 is, there's my short-term debt, and then G27 is my, where's my long-term debt? Right there. There's G27. Right there. All right. Add all of that up. So what I've done is I've taken net income plus depreciation minus net working capital minus CapEx plus net borrowings. And I've structured these so that if the signs are the other way, it'll still work. I've got two more steps, and we're just about there. Now I've got free cash flow in nominal terms, but I want to get it in present value terms. So this next row down, all I'm doing is discounting it back the appropriate number of periods. And again, I'm using cell references here. So I take my free cash flow, 1148, and I'm discounting it. There's my K right down here in K25, cell K25. And I'm discounting it for one period. I've got my year counter up here in row 18. And when I do that, I get a value of 1.034 billion. I do a similar thing for the second year, the third year. Obviously, each year I'm discounting back for one additional year, and that's what this row 18 is doing for us. It's taking care of that. And so you'll see it going back down. Present values keep getting smaller and smaller. So even though I have 1.294 billion in free cash flow to equity, I have a present value of only 768 5 years out. Then I need terminal value because the company, we're assuming, continues on in life beyond year 5. And there are multiple ways you can get that terminal value. The way I have chosen to do it here is to use dividend discount model, looking forward out to year 6 and beyond. You could use a residual income model. You could use the free cash flow even. So you could project out 2030's free cash flow and use that instead of a dividend or residual income. Yet a second different way is to use a relative valuation model here. So what you might take is earnings per share and multiply that by some sort of PE ratio that you think would be appropriate for the company at that point in time. It's your choice as to which way you go. It's probably a good idea to do both. Do one that's a fundamental valuation technique like a dividend discount model. Do a second one where instead of using that, you are using a relative valuation model, preferably using either PE or EV to EBITDA. Either of those would be good ratios to use. And so now I come up with a value here of $6.9 billion for the value of the firm as an ongoing operation beyond year 5. Now, I take that amount and I still have to discount that. Let's see. Where did I? Did I discount that already? Not sure. I think I messed up. I didn't discount that. Let me fix that. This really needs to be discounted. Let me move this over so you can see what I'm doing here. Let's see. So it's the 027 that I need to discount. And what I'm going to do is just open parens, and I'm going to divide that by 1 plus our discount rate of 0.11. And then I'm going to raise that to the 5th power. And I'm going to use this reference up here. And then I'm going to close that parenthesis. I've already discounted the amount in 018. Or, 025 rather. There we go. So now I have this 4.865 billion right here. This amount is my terminal value at the end of year 5 plus my year 5 free cash flow, both of them discounted back 5 years at 11%. And then 792 is just my, my discounted cash flow for year 28. And then 819 is discounted cash flow for year 27 and so forth. At the end of the day, I'm going to add all of those up. Oh, sorry, no, there's my first year cash flow. Then I add all of those guys up. So that's what this is doing. Aggregate DCF. So I have a total of $8.353 billion is my aggregate value for the firm. I divide that by the total shares outstanding, which comes off of the income statement. It's G47. So it's right here. It's that 104.1 million. And since it's already in millions, I have to make a slight adjustment to it. So that's what this million up here is. And voila, $80.24 is my estimate for the value of J.M. Smucker. We're at the end. Questions, comments? Everybody think they can go build this? Are you ready, Evelyn? Chris? So go ahead.
I just have a quick question about the expected growth rate of revenues. So is that first step in our document that says compute the growth rate? Because I know it was talking about possibly using a sustainable growth rate, but
Yep.
I just want to confirm that that's for our revenues, correct?
Yes. Yeah, and I think probably while I like to compute a sustainable growth rate just to see what it is. Most companies don't just grow without issuing equity or debt. So I think a historical growth rate is a better estimate. But I do like to know what that number is. So it's worth computing it. And so you're talking about right back up here, I believe, right? Right here under the pricing of the stock. Yeah. So as a starting point, I would do both sustainable as well as a historical. And if you see any trend, you might want to add that in just to see what it is and then make a decision. What do you think is most accurate, most likely in the future. Remember, the whole goal is to try to match up our projections with reality when the company actually gets there. So, and then add to it these forward-looking measures. And those are more qualitative things where you might be saying, okay, well, I looked in and again, I'm making this up, but as you read through the industry forecast, let's say the industry forecast, they project 4% growth, which is way above what they were growing in the last 5 years at only 2% growth, say. Well, what do you think is going to happen with AIT? Is that going to change their future growth rate? And I would say, I would guess so. So I'm going to, whatever I projected historically, I'm going to add a little bit to that to reflect the idea that the industry is going to grow, the pie is going to grow, and even if we keep the same market share, we'll still grow at a slightly faster rate.
And then, sorry, just to clarify, the average historical rate you're talking about, the growth of the revenues over the past.
Yeah. Yeah, so you could literally do that right here on the income statement. We could look at, we could go up here and go, let's see, we take this minus that divided by that. So revenues grew at a little over 2.5% between end of fiscal year 2020 and 21. And then we had, we had a decrease in revenue, a slight decrease, and then we had a 6.6% increase, and then we had a negative 4%. So this company looks like it's all over the place. But I could also do, let me do an average of those. On average, it grew at 1.25%. And then I would add to that those 4 qualitative factors. Some might increase it, some might decrease it. Maybe the industry is expected to grow, but the economy is expected to shrink. So the industry might cause it to grow by an extra percent, but the economy is shrinking, so it might actually grow at 0.5% less as a result of that. And then you've got 2 other qualitative factors. Specifically, I'd like some of them to be directly related to AIT. So what do you think AIT's goal is? And again, this is something you might learn by reading through the 10K, reading through the 10Q, listening to the earnings calls, or looking at the transcript, looking at what Bloomberg is saying, or any of the other analysts, if you can get a hold of an analyst report for AIT. Yeah, good question, though. And let's see. I'm trying to think if there's anything else. I've got a little bit of a thing here on. You might also look at some of the information on Aswath Damodaran's website here. He's got some great stuff for valuation. And if you run into a difficult situation, you might look there and see if he's covered it. So he does stuff like, how do you value a distressed firm? How do you value a low growth versus a high growth type of firm? That sort of thing. So that's another resource for you. I won't. I don't share this spreadsheet, but you can certainly go back to the video as you build your spreadsheet. If you've got any doubts, I would click back through the video and see if you can find the answer. If you don't find it there, then there's always an email to me or office hours or what have you. I'm happy to help once you've gotten into it. Inevitably, you get into it and you discover, oh, wait a minute, I don't remember how we did this or that. Any other questions?
Yeah, I have a question.
Yeah, go ahead, Chris.
So what you just covered was everything for this deliverable?
No. Still have to calculate the growth rate. You still have to calculate a beta and then get your K from that. You still have to do the back of the envelope fundamental valuation technique using either dividend discount, free cash flow, or residual income model. And then finally, you still have to do a relative valuation, preferably using either PE or EV over EBITDA. Yeah, the whole thing is right here. Let's see. So you're starting right here for the second deliverable. So we did the pro formas, and we did the DCF part of it. So this part 5, that's what we just covered. You'll also want to do some sensitivity analysis, and then that's the end of the deliverable too. So there's a lot of work in here. How about you, Tyler, Trent, or Antonio? Any questions?
No questions exactly, but it was good that you cleared up the fact that this was just part of it, and we still like have to do the growth rates as well.
Yep.
Gives us a better estimate of the fact that we should definitely be starting this right now.
Yes, for sure. And by the way, I mean, you can be starting on this. Just plug in a K and a G that makes sense. You know, put in 10% or 5% G, 10% K, and then when your teammate gets the actual G and the actual K, then you can change it, and everything will update immediately. That's
Thank you.
sure.
Appreciate it.
Yeah, that's the beauty of spreadsheets. And I'm also available via email if anything comes up. If you get to a stopping point or a point where you don't know where to go from there, feel free to just reach out by email and I'll get back in touch with you. All right. Have a good weekend.